So keep your eyes out for him. Okay, great. So the motivation of this paper at some level is similar to the previous one. So this is GDP per capita in the US with a trend line up to the pre-crisis period. And so this is a graph and a fact several other people have talked about and theorized about. The idea that the Great Recession seems to have been relatively big relative to the post-war history, but also seems to have induced a particularly persistent slowdown in economic activity, right? So that's kind of our motivation. This paper is going to be about thinking about this phenomenon, and it's going to explore, the paper is going to explore a very simple kind of idea, and I'll tell you what is key in the idea and what's not so central. The idea that a tail event, a negative event like this, which happens relatively infrequently, but is sufficiently bad, is going to induce belief changes in the economy, and these belief changes are going to have very persistent effects on economic activity. So this persistent change, this persistent stuff is what the paper is essentially going to try and convince you is an outcome of events like this. So that's the connection we want to draw. That's the case I'm going to make in the next 40 minutes or so. Okay, so let me kind of give you the main mechanism in a nutshell, and then I can show you some results. I'm going to write down a very standard neoclassical model, or more or less standard neoclassical model, where the only twist is that agents are not going to know the true distribution of aggregate shocks, but are going to learn about that as new data arrives. Then I'm going to take that model to the data. I'm going to show you how I map the primitive shocks to the data. Agents are going to update their beliefs using a non-parametric approach. I'll talk a little bit about why and what role that plays. Mainly, it's going to give us a lot of flexibility, which matters a little bit quantitatively. Right, so that's good. Those are the ingredients. What's going to happen? A big event like the Great Recession. That's the experiment I'm going to run in the model. It's going to lead to fairly large changes in beliefs. That perhaps is not that surprising. It's a big bad event, so beliefs change a lot. But the more interesting thing is that those belief changes last very, very long. So part of that comes from thinking if you think about it from a Bayesian perspective, beliefs are going to be martingale, so there's going to be a permanence in belief changes coming from that. But I'm also going to, if I get time at the end, I'll show you that even if you thought that the Great Recession was a freak event, that we're never going to see something like this. Even in that setting, the belief changes induced by the event are going to be quite long-lasting. So there's a sense in which the persistent effects of these events is going to be quite a robust prediction of this framework. So that's it. Without further ado, let me jump into that. One of the things I'm going to show you towards the end is that this narrative, apart from whatever intuitive appeal it has, it's also consistent with data on asset prices. So that's another kind of external validation that we're going to use to kind of support this story.
Venky, how do you disentangle these from other trend stories? There was a truth. I'm going to talk popular phrase. There was a structural change, and that's what happened. You have a one event, so are you going to run into some inspiration or something?
There are some types of structural changes I have no hope of distinguishing, but maybe some I can say something about. But hold that thought, and if later on ask me that again, maybe we can get into that. Okay. All right, so I'm going to start out by saying what's really new. The belief formation piece is what we are adding new. So let me tell you a little bit about how we model it. That's a little bit non-standard, so I'm going to spend a little bit of time on that. The economic model shouldn't come as a surprise to anyone in this room. And then I'm going to spend some time on the results and robustness. Okay, great. So think about an IID shock variable phi t. I'm telling you it's IID, so you know it's IID, but you don't know the distribution G. And I give you a finite sample of realizations of that, right? And you're trying to estimate that distribution G. So one approach would be to say, I'm going to impose some parametric structure on G and estimate the parameters of that model. We're going to go a slightly different route because we want to kind of take seriously the idea that this could have this, distributional, or this could behave very differently in the tails. So we're going to use a standard non-parametric estimation estimator, the Gaussian kernel density. And so this is the formula for the Gaussian kernel density. What it basically does is it takes the empirical distribution of the observed shock from the sample and draws a smooth kernel over it. Right? That's basically all it does. So if you think about this estimator as essentially the empirical distribution, you're not going to be far off. Right? So that's what this does. Okay? So for example, this is going to correspond to something I'm going to show you in the model. For now, just think about this as some random time series with a big bad realization. So this is some series which is bouncing around, something like 0.12, and then you get these really bad realizations here. So here is what happens to that estimator. Here is what happens to that estimated distribution after seeing these two things. And what you see here, the blue line is what you estimated up until this point, and the red dashed line is what you estimate from the full sample. And what you basically see is the small bump in the left tail. Right? That's what I meant by saying it takes the empirical distribution and draws a smooth distribution of that.
What's the advantage of doing the smoothing instead of just using the empirical?
That is not much, except, we want to kind of, this way we don't have to keep changing the support as we do this. Other than that, not much. Otherwise, the empirical distribution is pretty damn good. And depending on how you specify the bandwidth parameter, this is almost close to that.
But the issue is, what is the empirical distribution? In a way, this is the empirical distribution.
Sorry?
The thing is, what is the empirical distribution? There's no.
Yeah, you pick some bins.
There's nothing such.
No, he's saying like literally I could just say if I have 50 years of data, I can just resample from that 50 years of data. I could use that as my distribution.
You have to pick the bins in order to form it.
Yeah, so I have to make some choices about, I have to make some choices whether I want to literally sample the same values or sample around them. This is just one way of doing that, but it's not crucial what assumptions.
This means that before and after, I will always get the blue line, kind of, that's the idea. It's only the fact that in 2008 that gives me the king. But before and after, I would always get the blue line.
No, so I want to, when you say before and after, I'll always get the blue line, what exactly do you mean?
Before and after the event.
Oh no, we'll talk about output now. This is just an example. I'll talk a little bit about output in a second. So I'm just saying, this is just saying how beliefs change in response to these negative events. And what this panel is showing is, if I simulated data from this distribution, these belief changes this is basically, if this was Bayesian, I don't need to show you this. I would just assert that beliefs are martingales and we'd be done. Here, because it's not exactly Bayesian, I have to do this thing. But this property more or less is pretty much almost exactly right. So don't, hold your thoughts about what this means for economic activity, because that's what I'm going to spend the rest of the talk on. Okay, so this is going to be the piece that's going to be appended to the economic model. All right, so let me go into that. So the model is based mostly on Gurio's papers, one in the AJ macro, except for this belief piece. So production, which is where most of the action is going to take place, a bunch of firms, they're going to produce with production technology, KIT, LIT to the alpha. There are no TFP shocks. The only aggregate shocks in this model are going to be what the literature now calls capital quality shocks. So what these shocks are going to do, they're going to scale up and down effective capital in the economy. So each period, the economy accumulates capital according to a standard equation. And so you have some initial capital K hat IT plus 1. That gets scaled up and down by this phi t shock. So it's more than a TFP. It doesn't just affect the productive value. It also it scales up and down this capital shock. And that specification is going to at least quantitatively matter. We could have done the same analysis with TFP. This turns out to be more I'll show you the data we used to discipline this, and that will kind of tell you why we went this route here.
Okay, so people have used this to understand business cycles, right? So the price of capital and the price of investment. But do we see such a big jump in the price of investment?
I want to be careful about this. So that's a good question. The price of investment here in terms of consumption goods is always going to be 1. The price of new investment is always going to be 1. What this captures, and maybe this is a good time to address this question, okay? So yeah, I know, clearly. Yeah, if you have any questions, that's my, yeah. So let me tell you what this is going to capture. Maybe this is a good time to answer this question. So, in 2007, you build a new hotel. It costs you $100 million. There's some cost of the land, cost of the building, cost of everything else. It costs you $100 million to build it. Now, it turns out that you built this hotel in the middle of the desert near Las Vegas. come in the recession in 2008 and 2009, the demand for that rooms basically didn't exist. So if you tried to resell that hotel in 2009, you would get $80 million. It's that erosion from 100 to 80. So if you wanted to build a new hotel in 2009, it would still cost you $100 million.
So it's isomorphic to stochastic depreciation?
Yeah, it is going to show up exactly like a stochastic depreciation shock, but it's going to be big. So the numbers I made up on the fly are like about the order of magnitude. And we're going to use prices to infer that. So we're going to look at the market price of this hotel in 2009 to back out what effectively it has depreciated. Not so much the replacement cost of that hotel.
Okay.
That's the subtle difference. And I think that's where this is going to behave differently, and that's where a lot of the action will come from. Okay, so that's the only aggregate shock in the model. That's what people are going to be learning about. Then there's going to be some debt. This is going to give us a little bit more quantitative action. For the basic learning story, this is not crucial at all. Firms are going to be borrowing with one period defaultable debt. There's some idiosyncratic shocks. You're going to get some default in equilibrium. But these are all just, these matter a little bit quantitatively, but overall, this is not going to be a big piece. On the household side, things are going to be simple. There's going to be a representative household. They're going to have Epstein's in preferences over this bundle. Risk aversion is going to be an important risk aversion, and IES are going to be important parameters, and that's why the Epstein's in specification comes in handy, right? So the new piece is this: that agents they don't know the distribution of this. They know this is IID. And all they're going to have to figure out is what that distribution is. And they're going to have some data that's going to give them a finite sample of these fees, and they're going to use that to estimate the G.
Under what assumptions on the use of agents is this Gaussian kernel density estimator optimal? Do you know anything about that?
Short answer, not much. I mean, this is like saying, when is non-parametric estimation optimal? That's kind of a way of stating your question.
No, that's okay.
Oh, you mean Gaussian versus some other kernel? Is that what you mean? So,
since this is the one that you're using.
Oh, that's a good point. The only thing we did we don't have an answer to your question. What we did do is we experimented with a bunch of different specifications, and that didn't matter that, the choice of the kernel didn't matter that much. What is important is that whatever learning protocol they used kind of takes tail risk somewhat seriously. Like, for example, if agents were fitting a normal distribution to phi or a log normal distribution to phi, that doesn't work so well. I'll show you results of that, and I'll tell you why it doesn't work so well, or why it wouldn't have the results it wants. So that's what's important. It's not important that we use the Gaussian kernel density. We used parametric distributions which have a significant tail component. All of those gave us very, very similar results. That's what is key is that you have a learning protocol which treats the tail, with respect.
Because
Sorry.
The other thing that's hidden in all of these papers is that agents know nothing about the distribution of theta, but they know everything about how.
Sorry, what's theta? Phi? Oh, sorry. Yeah. Okay.
They know nothing about distribution of phi, but they know everything
about the structure.
How this G hat maps into the prices.
Fine. Fair enough. No, that's a good point. So that's a fair point. So we could, that's not I agree with you. That's not a great feature of these models. I don't have an answer for you in terms of what we haven't done any exercises which relaxes that assumption, but that's something certainly we can think about. I'm happy to talk about later about what we can do on that respect. Okay. All right, so now, so this is the model basically. I'm just going to show you now how I measure these things in the data, and then I'm going to just let this run. Okay, so here's the basic idea. If I'm going to look at the data through the lens of the model, this phi is basically the ratio of some measure of effective capital, after the stochastic depreciation or whatever has happened, over what capital I came into the period with, right? So how are we going to measure that in the data? We're going to use CDs or non-financial assets from the flow of funds, and in particular, we're going to use CDs the flow of funds, so most of the non-financial assets in the flow of funds is commercial, about half of it is commercial real estate, the rest of it is equipment, software, other stuff, right? So the flow of funds also reports a market value series for that. They measure commercial real estate at market value, they measure the other stuff at market value or replacement cost, whatever they can get their hands on. But so think about this as a market value series. So what we're going to do is to map this market value series to our notion of effective capital. We're going to use their historical cost, or basically previous investment, as a way of getting the denominator. And together, both of them allow us to back out fee.
One thing, Venky, think about is land. How exactly?
Yeah. So in this, you're absolutely. So we were worried about that too. We were worried that a lot of the fluctuations in this are coming from land. It turns out, I'll tell you why we think now that that's not the case. We don't have, so the flow of funds doesn't take commercial real estate and say this much is land and this much is the rest. It just reports one structure. But we have, from the historical cost data, we know how much of this commercial real estate is land. From the historical cost accumulation. And that's very small.
But it fluctuates a lot.
Sorry?
So the land value fluctuates a lot because of supply is limited.
I don't disagree with you.
The machine and the equipment.
But it's not machine, but it's the build. This is why I gave you the example of that hotel, right? So, you're absolutely right. So land was maybe, I don't remember, I think
all that Noble was saying, and I was trying to say, is the land might be a small share of overall investment, but it may well account for a huge fraction of the volatility in the effective market value. That's the concern.
I don't disagree with that. I'm just saying that, let me give you rough magnitudes. So land is about, based on this historical cost measure, land is about 7% of non-financial assets. Okay? And the kind of fluctuations, at least that's what we were surprised too. We thought it would be more, but it's not. It's only about 7 or 8%. Because most of these are fairly expensive buildings. So it's not like these are just,
Historical cost you are talking about.
Yeah.
So it's like some people buy it 50 years ago. It's peanuts.
No, even if you, that's fair. I don't disagree with you there. But even if you look at, the way they constructed is using flows, it's not that different. It's not that different. We don't have, I agree with you. Ideally, we'd like to have this thing broken up into market value of land and market value of the structure. That
funds is historical cost, not the...
No. So I agree. So I think the only thing we can, I want to distinguish two things. This is market value. That hotel example, they actually go out there and try to estimate what that hotel would sell for today. That includes a component for land, that includes a component for the structure that's on there, but they don't break it up. The only way we break it up is to say, when you bought this hotel in 2007 and spent 100 million on it, at that stage they break it up. So in the historical cost series, they break it up.
Commercial, it's only that. For residential, it's,
Sure.
people think it's like 1/3.
I think that's correct.
Well, he's California, that's why.
That's why, yeah. No, I agree with you on that. But most of the country does not live in 60%.
All of one is not California.
Yeah, Palo Alto. No, I agree with you. I think this is less because, like I said, these are fairly large structures erected on relatively small plots of land. So I think that's exactly why this is right.
If I think that way, then what is output? Because output then is not NIPA output, because it doesn't have capital gains, right? So what is output? So capital gains don't go into income.
I agree. I don't have,
But your changes in, you're talking about the price of...
No, output is NIPA output. I'm just saying, all I'm saying is that hotel is going to produce less GDP in 2009, right? And whatever it produces in GDP is measured by NIPA in the usual way, right? All I'm doing is to say that the value erosion is what I'm going to use to back out what has happened to this.
I think what Raul is trying to say is this view that, okay, the hotel is worth a lot less because it can't house as many guests.
Or
looks crazy.
no, not because it can't.
House as many guests as before. It's because some other jackass is willing to pay less.
It can house. It's just that those housing services it's radiating in 2009 are worth less.
It has a direct effect on GDP, holding labor input fixed, that defines borders.
No, it does not have it. I'm a little bit lost.
Yes,
No. In the no. Okay, so there's two things. In the model, this is the shock that is going to lead to GDP falling, right? What it captures, so what is the assumption under which that's a sensible way of modeling, is this assumption that when the price of that hotel falls, the fall in the price of that hotel reflects, the fall in the discounted present value of revenues that hotel produces. So in the model, there's going to be a mechanical mapping between the fall in the valuation and the fall in the discounted present value of that.
I think if you don't use the word selling and buying, it helps. Like selling, buying.
Okay, we can, anything that helps is always welcome. So that's good, so we'll come back to that. No, but I want to kind of emphasize this. We looked at something like rents. Right, so one thing would be to say, okay, what is the flow value that this asset is producing? For commercial assets, again, we don't have rents for the whole country in any meaningful way, but we have some data on rents, and rents show almost exactly an analogous drop, at least in commercial. So in residential, for example, partly, and this is where your comments about residential are on point, in residential, that's not true. Like, rents didn't fall as much, prices fell a lot. And that's where you might be worried that the economic value of this thing hasn't depreciated. It's just that the market price is depreciated. I think for commercial assets, this looks a little bit better. But your concerns are not invalid at all. Neil? Yeah.
Just to follow the language of Charlie, is a lecture on the joint hypothesis. I just want to understand.
Yeah.
You have the information structure. That's one thing. And then you have this shock that is generating all these. You could apply your machinery to other types of shocks. So
we have, yeah.
Are you married to this shock because that's the one that works for you? So it's purely because of the quantitative point.
So there's two things, right? So, this type of shock has a couple of advantages for us. One, this procedure gives us a way of inferring the shocks from observable data. The structure allows us to use this procedure to infer that. If, on the other hand, this was TFP or some other component, the inference of the shocks would have to be through the lens of the whole model. Like, pricing.
Let's say Charlie comes to you and says, here's a sequence of shocks.
I can do it.
You can take it.
I can do it.
And then we see
Yeah. So we could take, give me TFP shocks and we can just run it inside and we can do that. Yeah, absolutely. And that, at least, basically would not have as much of an effect. And you can already anticipate why. Because this is a really big shock. If I told you that 15% of your capital is going to erode in value by 15% next period, you're really worried about that. If, on the other hand, all I'm changing is the flow profit from that, whereas you're going to get 1 minus delta, that is 0.95 for sure, that bounds how big an effect you can get from belief changes.
The workers in your model that it's a new economy, their skills.
Yeah.
10% of their skills are lost. That's a huge shock.
That's exactly what. Yeah, that's fair. Sorry.
I'm just confused. In order to make the discussion simpler, assume for a moment that labor is inelastically supplied.
Sure. That makes no difference. Yeah.
Okay, good. In which case, given your Douglas production function, what is the difference between fee affecting the equity capital stock affecting investment?
Sorry, fee affecting? Yeah, so
being a standard solo residual.
Yeah. This, right? So yeah, so what's the return to capital? I used to have that on the file. So return to capital is phi t, whatever kt you had, blah blah blah, alpha minus 1, all the usual stuff, plus 1 minus delta phi. That's that, because without that, the return on capital is bounded below by 0.9. By the worst that can happen to you is a minus 5% return to capital. This is going to give you a lot more. This is where the action comes from. So this is like saying you are putting in place capital that is so irreversible that if nobody wants those hotel rooms, that capital is gone. That's what this basically gives us a way of capturing. And you need something that big to get the effects, in the market. Yeah.
What about portfolio composition? That you get the budget to hotels, so you don't invest in more in hotels for the future?
Yeah, so that's a fair point. Ideally, we'd like to do this with different types of capital and all of that stuff. We haven't done it, but that's worth thinking about. Here, this is going to be one type of capital. The idea is saying you don't invest in hotels in Las Vegas anymore, but you'll invest in hotels somewhere else where people want them. All right.
one question. So,
Yeah.
you told something about leverage and default rates. You didn't mention much about this. Boring, is it important?
Yeah, it's all very boring. That's why. It is actually. So I honestly, like, we started out, this is some history dependence. We wrote a model thinking, oh, this would be like a super powerful channel. It's going to account for like a third of our quantitative results later. But really, in terms of economics, this is not drastically changing things. It does a little bit, but it gives us some testable implications. Like, for example, Bob Hall has a paper on the secular stagnation. So he argues that this can't be increase in tail risk. It can't be that people change their beliefs about tail risk because credit spreads should have blown out if that was about tail risk. And we can actually ask that question in the model. And in the model, firms delever in response to that. And once you take that deleveraging into account, the change in credit spreads is actually quite modest. So we can do some additional tests like that. But the central mechanism, this is not going to be a key part of that.
Sorry.
Yeah.
So my understanding is that one reason we are doing this layout, introducing the shocks, is to generate persistence while we still have the IID for the shocks to keep it. So
No. Persistence is not. I have not told you anything about persistence. This is just saying these are big shocks. This way of modeling it makes these shocks big. And if this was just a standard solo residual TFP type of shock, you can be more worried about getting a negative event. But you're start living in a world where worst, even if you get nothing from, even if TFP is literally zero, your return to capital is a minus 5%.
But with persistence, you could have it big, right?
Sorry?
With persistence and
No, but I'm saying I want to kind of distinguish two things. Persistence is not going to come from the structure of the shocks. Persistence is going to come from the learning process. Is that what you?
He's just saying an alternative way to get a really big shock.
Oh, is to think that these shocks are persistent.
TFP shock.
right.
Instead of a transitory.
At some level, you have the
That's exactly that. That's exactly what this is.
So I think you're agreeing.
Yeah, you can generate as big shocks as you need while having a simple shock process, right? So that's.
Sorry, yeah, you're saying we could have alternatively, I could have written down a model with extremely irreversible capital and persistent TFP shocks. That would give me exactly this.
But you have persistence through the capital accumulation. Venky, right?
No, but there's a difference. Yeah, hold these questions because when I show you the results, you'll see where what persistence matters and nothing. I think thank you, Chris. I think, yeah, you're after something else. You're right. This is meant to capture extremely persistent TFP shocks and basically irreversible capital. That's exactly right. Okay. So this is what that series looks like from the data that I talked about. So it bounces around 1 for the most part. It's a little bit more volatile here. And then you get these there are two really bad realizations out here. One of them is like 0.9 something and the other is like 0.85. So between 2008 and 2009, there were like these negative realizations of about like minus 15% returns to capital. Right, and that's what happens to the distribution. This is what that does to the distribution. Much like what I showed you in that simple example, this is exactly this one. Okay, so now what does this mean for the things we care about, for output and so on and so forth? So here's the thought experiment. Here's the baseline thought experiment. There's a whole bunch of other stuff in the paper, but let me talk about the baseline one. I'm going to start at I'm going to estimate the 2007 distribution. I'm going to start at the steady state. Even this doesn't really matter that much. I'm going to start at the stochastic steady state associated with that. I'm going to feed in the actual shocks from 2008, 2009 and re-estimate G hat 2009. Exactly what I showed you on the previous slide. And then I'm going to simulate future paths for this economy. In the version I'm going to show you now, these future paths are going to be drawn from the newly estimated distribution. So there are going to be different time paths. I'm going to average across those time paths and show you the average path. Right? So this experiment I mentioned earlier about saying, oh, if you thought that 2008, 2009 was a freak event, then we shouldn't be simulating from what we estimated in 2000. We should be simulating from the old distribution because this was just some freak event. The true distribution is actually something like this. And we do that in the paper as well. Right, so this is what I'm going to show you right now. Okay? So here is the shock. Everything kind of normalized to the mean. So here is what I meant by saying the negative shocks, about 15% or something like that. The shock itself is IID. Right? So that's why, you get two realizations, sure, by assumption, because that's what you fed in. But after that, the shocks are on average equal to their mean, roughly 1. Right? So after that, there's no difference to the shock. Right? What happens to GDP? And for the way maybe Raul was talking about at the beginning, almost mechanically, because of this, they're going to reduce output. So the fact that they produce a drop in output, is not that surprising. That's what the impact is going to be coming mechanically from the structure of the shock. They're going to look exactly like a TFP shock in that respect. And what's interesting, though, is that the economy shows no desire to go back to the old steady state. Right? So the economy, the level of output remains depressed at this new level. Sorry?
In the basic expectation, this just converges from below.
Yeah, I'll show you the...
So how, you will still have slow, I understand it's not going to be as slow.
No, here...
The accumulation is going to dictate the dynamics.
No. That's so. Let me see if I understand your question correctly. What has happened in the shock? I've basically just wiped out a bunch of capital of the firm in the economy. The economy has a strong incentive to. That force is here. What's different is that because beliefs have changed. That's coming. That's the next slide. Yeah. So what's key, is that the belief thing is so strong that even with that, you kind of change this, right? And it is. In this version, it is. In this version, because I've changed the distribution. That's what I'm saying. So
no, but presumably what I would be seeing, if you simulate it, not an impulse response, but if you simulate it along a particular realization.
Holding the distribution of shocks fixed throughout. Yes, that's what, so that's it. So,
and eventually it's got to come back.
But that I'll show you in a second. So I'll show you that picture in just 2 slides.
You're doing a simulation where you're holding P equal to 1 or something like that after 2000.
No, the thing we're doing in these pictures, and that's why some of this is, kind of comes from this Martingale property. So I'm just saying, my agents have a new distribution that they've estimated, G hat 2009. I'm saying I'm as good as my agents. The best thing I can do is to use their distribution and simulate the economy forward.
It feels better. You can use the realized shocks.
Yeah, we've done that too. Yeah, I don't know if I have the slides, but we've done that too. Yeah, but what I want to kind of emphasize is, the idea that these things are going to last for a long, long time. And that's what the realized shocks at least limit us, because we have 4 or 5 years after that, but it's not, this thing.
The economy will at some point converge to...
Not in this version. That's what's my response to Charlie.
The new distribution.
Correct, but in the old one.
Steady state for the new distribution.
Correct. So, if I said, that's what I was saying. So suppose I could say, no, this is just they have just become, unreasonably pessimistic. The true distribution is this, and this true distribution is throughout this case. Then eventually it will go back to this thing, but I'll show you in a second the simulations. Over like 30 years, the 2 lines are on top of each other.
But if people keep learning?
Yeah, even though people keep learning, exactly. People are always learning. Even here, people are constantly updating. All of that learning is still happening exactly the way it is. In the other version, if the true distribution was 2007 shocks, eventually people will figure out that is the true distribution. But that is extremely slow. That's the point I want to make. That's exactly right. Right, so let me show you, okay, this is the data, we overlay that, it broadly looks similar, but let me kind of do these kind of effects that we're talking about. Right? So this is what happens, this is Near's question. Suppose there was no learning. So what's the no learning? This would be like the standard rational expectations assumption. Agents always knew the distribution from the very beginning. Right? So then all this does, it's going to lead to an investment boom, because I've just wiped out a bunch of capital and the economy wants to invest like crazy. Right? You said, we don't have hotels that we like, and so we kind of start building like crazy, and so the economy eventually converges.
This is an artifact of your growth motion for capital. Because K
that's exactly right.
K, not on K hat.
No. So it is an artifact of the fact that the shock acts like a destruction of capital. That's what I mean.
All the more reason to go away from GHH.
Okay, GHH, so we did...
Look at the investment.
Picture. So if you do Near's trick with GHH, we are okay. It doesn't change that much.
No, but you want investment and labor to move together in the same direction.
No.
You're trying to make fun of the green model.
No, but hold on. You're saying if we went away from GHH, these guys might start working harder. That's what you're worried about.
Yeah, I want investment. If investment goes up, they're working like crazy now because they're cutting back on consumption like nobody's business.
That's true, but I don't think if I want to depart from GHH, you're right. It will make the green dashed line look even more ridiculous, but my blue line will also, inherit some of that ridiculousness.
What I want to see. I want to see that.
I'm a nice guy. I don't want, okay, especially when it comes back to bite me. Yeah, so that's, you're exactly, so what we did was what, Neil taught us, and we have like the GHH, like a slowly kind of adjusting GHH from this thing. Wait, what do we call those preferences?
Those are called epicycle.
10, okay, perfect. All right, so let me show you a couple of this thing. So first I want to quickly highlight something about asset markets. There's a whole bunch of other stuff in the paper, but I want to kind of highlight something this is useful, right? So one place you would think, okay, if you think that what has changed is people's distribution about bad events that can happen, one place you would think that would show up is in options prices. Right, so you think there's a change in the shape of the distribution that we posit. How consistent is that with evidence on options prices? So the only place where we have options prices that we can, or at least we've been able to find options prices, is on the S&P 500. So much like the VIX, which is basically tracks the second moment of the distribution, there's something called the Skew index, which does the same thing that the VIX does, but for the third moment. So there's some slight adjustments required. So you can do this, you can basically use that Skew index, which is published by the CBOE for the same time period, and compute something like this. So we have an equity in our model. We can literally price this option on equities and compare it to the price of options in this thing. So in particular, you can calculate this object, which is like the risk neutral expectation of the third moment, or you can ask, what's the probability under the risk neutral measure that this stuff is below some 30% stuff. And here is how that thing changed before and after the recession. So one of the puzzling things about one of the things that the finance guys have been puzzling with for a while is that VIX is super low, but Skew is actually has been high and has been high for a while. So this, at least loosely speaking, I mean, we can't quite rationalize the drop in VIX, so I'm not sure we have full success on that, but at least it kind of rationalizes this idea that what shifted is that people are a little more concerned about the tails than they were before that. And quantitatively, this lines up. We don't match all of it, but we get a pretty significant kind of movement in the tail risk. Right, so that's something, again, this is something we've not used in the data and the calibration or estimation at all. So this is something which is kind of encouraging. Right. It also, there are other stuff like the risk-free rate falls, a whole bunch of other implications for asset prices, which I'm going to defer here.
Change even much more.
So the
level of stock prices.
So we do that in the paper. We do level of stock prices, stock prices to capital. The level does not change as much as you would think because there's two effects.
The level of stock prices.
So what he wants you to do is not relative level of stock prices relative to phi k, but relative to k, relative to historical cost.
So output, yeah, we did output and K. I'm trying to remember now if we did effective market value of capital or we did book value. So the problem in the data, that stuff has gone up, especially in the last 2 or 3 years. Stock markets have been on a bull run, so that stuff is, so we don't quite get that. But in our model, stock prices normalized by GDP actually go up a little bit. And the reason they go, stock value, market cap over Y goes up a little bit. There are a couple of reasons for that. One, remember, there's like interest rates go down, risk premiums widen, but interest rates go down. So the return on equity, is not changing as much as this would suggest. Second, deleveraging means there's more left on the table for equity guys, and so that makes market cap higher. So together, the drop, we don't really get a 20% increase in market cap, which is what is in the data. Let me see if maybe I can even quickly show you this. Yeah, so here. So we just we get a slight increase in the data. Equities have gone up by 20%. We can't explain that. Okay.
I mean, this stuff has significant implications for labor productivity.
Now we want the simplification of the model.
Sorry, you want to do Y over L?
Yeah, Y over L. Because
we get Y and L more or less right, so I'm going to say we get Y over L more or less right. But, unless you have something.
Because this research of productivity actually went up. The productivity, and you have this huge shock to capital, so Y over L has to go over. I'd be very surprised if you get that much. Forgetting magnitude signs, I think.
No. But I'm saying, you're right. That upon impact, Y over L, there was some debate about whether productivity went up or down. But if you look at, after that, it's not that different. Yeah, I'm sympathetic to that. I don't want to sit here and claim this is the only shock that hit the economy and we're done. So here's the other experiment I was telling you about. So here, suppose we say, this is just a freak event, or we're just going to draw from G hat 2007. So eventually this line, that's the green dashed line. Eventually this line is going back to 0. But it takes a very, very long time. And that's where some of this kind of non-parametric stuff, or not so much the non-parametric stuff, having this flexible distributional stuff matters. Suppose we had assumed that the distribution was normal. Right? So suppose we said, phi was a normal or a log normal distribution and estimated that. What that means is learning about the parameters of a normal distribution. You learn about the parameters of the normal distribution from realizations everywhere. Whether it's good, bad, all of them are going to be informative about the two parameters that you're trying to learn about. In that world, you would learn very, very quickly. Whereas the non-parametric formulation, in a sense, captures the idea that the stuff that happens in normal times is really not that informative about what's going to happen in a crisis, or what's going to happen in a really bad realization. So that separation kind of at least partly lies behind this persistence.
Take the step on labor, you've got to be a little bit careful. Because over this period,
sure,
the baby boom is really rapid.
No, we'd like to, I agree with you. I think we should actually try.
I've done numbers which say about half of the decline in labor is just baby booms.
Which is not bad for us, because I think we actually overshoot. So the data actually shows a bigger drop in, this is employment, so right, this is not unemployment, this is employment. And so this has all this other crap inside this. Maybe we should clean that out and then look at like some adjusted drop in employment. I think that's a fair point. Yeah.
So how does the model perform before the recession? Like, you use 50 years of data. It'd be good if we know that the model is great for those years as well.
So so there's two things. I think this shock, as I showed you before in the observed time series, before the recession did not have much variation at all. So in other words, if I took this model before the recession, there wouldn't be much cyclical fluctuation at all.
You would want that model to get like the unconditional movements, right? The volatility about.
I would only if I thought this was the shock that, I'm just saying, I actually think that's what I'm trying to say is this was actually an unusual event. Something like this phi does not usually show up in our business cycle analysis.
But you recovered from the data using all the data from 1950. So you're saying it didn't happen, but I'm going to recover.
No. I'm not saying it didn't happen. I'm just saying it did not play a crucial role in cyclical fluctuations. Like what happened in the commercial real estate market was not a big deal for most recessions from 1952 to 2007. It's just, that's what made this such an unusual event. So,
the point that you're trying to make, which is a legitimate one, is on a whole bunch of co-movement dimensions, this doesn't look that different. And so therefore, what you want is a consistent theory of business cycles. Produces similar co-movement.
I'm going to push back on that.
Okay.
I'm going to push back on that because I'm just saying, this is very, very unusual.
No, I agree with that.
No, and this is not I'm just saying, I don't mean this one, I don't mean the model measured series. This is what happened in the commercial real estate market. None of those shocks, none of those recessions saw a 20% drop in the aggregate market value of commercial real estate. That's the shock.
Venky, the co-movement of output and labor, the co-movement of consumption, investment, yes, they're different, but they're not
that different.
Hugely different.
I'm sympathetic to that.
Therefore, you want a model in which other kinds of shocks,
I agree.
They're solo residual type shocks.
So that's right. So for example, no, that's a good point. So for example, we could to do the exercise you have in mind, we should throw other shocks in here, maybe TFP shocks, maybe monetary policy, you name it. We do those shocks, and to fully paint this picture, I have to convince you that previous recessions were mostly about those shocks, whereas this recession, was about my capital quality shock. And the structure of the model implies.
In a long-winded way, what I was doing was trying to suggest that that's what this paper is about. This recession is different.
Yes.
from preceding ones, but it's not that different along.
Fine. Now I understand. Yes, that point is absolutely well taken. Okay, I'm going to wrap up really quickly. I have a couple of minutes, but you know.
Yeah, just another question. So if you would start the time series in the 20s, with REDg regression, so what people are not so surprised about?
Yeah, so I love planted questions like that. Where is that? Okay. So, you know, so the trouble for us was we tried along to try and see if we can impute this series further back. We couldn't, so we did the next best thing. We made it up. All right? So, no, I'm serious. What we did was we just said, let's assume that we had, instead of 50 years of data, we had double that. We have whatever, 120 years of data. And we went into that, you know, series and said in 1929 and 1930, we're going to put in double what we saw in the Great Recession. So that would mean like output fell by 20% or 25% or something like that. And then rerun the whole model. So now, you know, the effects are somewhat attenuated. You know, the effects are somewhat attenuated, but it kind of is very sensitive to whether you think people discount the past or not. So suppose you think that people said, okay, you know what? The 20s were a crazy time, but like really that's not telling us much about this. Because, and the reason I think that discount, I mean, there's two ways you could have thought there's more data available to this. One is to look at the US in the past, and the other is to look across countries. You could have said, come on, you know, there's Japan, there's Argentina, there's all these countries where really bad things have happened. So why didn't people attach a high probability to bad things happening in that? But the same type of discounting that applies. If you went to the US consumer in 2007 and said, remember in Argentina, GDP fell by 15%, he'll say, dude, that's Argentina, man. You know, we are not Argentina. For what I mean, I'm not defending that point of view. I'm just saying the discounting in a sense formalizes that. So if you thought that people did not discount the past in other countries at all, and they had all this data, then yes, new information is not going to change beliefs by much. But even a little bit of discounting makes a huge difference here. But you're right. I think that's a fair concern where, you know, perfect. All right. I think I'm done. All right. Thank you so much. I'm happy to continue this conversation, you know, over coffee or whatever. Great. Thanks.